Hello everyone, welcome to Investing with Shakib. I'm gonna do a two-part video series focused on home buying in 2025. I'm gonna do these lecture style. So the first video, which is this one, I'm gonna cover the things that affect mortgage rates. So we're gonna talk about Fed funds rate, mortgage spread, kind of discuss why Fed can cut rate and mortgage rate still somehow goes up, or why there is a mortgage spread in the first place. Even if you're not in the market for buying a home, these things will teach you something new and essentially help you digest things you see on the news that comes out of Fed meetings. And the video 2 will be focused on my outlook on buying a home in 2025 with all the information we're discussing in this video, and also we're going to take into account of the new government that's coming very soon, the upcoming rate cuts, and the housing market conditions. If that's something you're interested in, don't forget to subscribe so you can stay tuned. Okay, so let's get started. Okay, so let's start with Fed funds rate. Fed funds rate is the rate that you most of the time hear in the news about Fed cutting rates or Fed's raising the rate, etc. So it's set by FOMC, Federal Open Market Committee, which is a branch of Federal Reserve. So Federal Reserve, FOMC, I'm just going to refer to them as Fed. And Fed funds rate, I will often refer to it as Fed rate. So Fed sets the Fed rate. Now, who does this rate apply to? It applies to banks when they're borrowing money from other banks, so which are like short-term loans. So you might be wondering, why are banks borrowing from each other? It's for liquidity. As of now, it's mostly for liquidity, at least. We used to have reserve requirements where banks had to keep certain amount in the reserves. But I think, as far as I remember, they set it to zero reserve requirement. So nowadays, bank will still borrow primarily for liquidity. For example, if they needed more money today because they had record number of withdrawals, they can just get it from another bank. They're not going to just tell their customers, oh, well, you got to come back tomorrow because we don't have money in our accounts. So when they do it, they essentially get a loan from another bank and they pay them interest, and that interest is at the Fed funds rate. Now, how does this affect us? So Fed uses this as their primary tool for managing inflation. If you think about it, during COVID, they had to cut Fed rate significantly because the economy was just shut down. So they had to boost the economy, right? Because we were essentially getting into almost like deflation because no one was spending money in terms of, there were no businesses running, nothing was happening, so they had to do something. So they had to make money, like borrowing costs, really low, so to stimulate the economy, right? There were other factors into play, but that's what Fed did, where they cut interest rate significantly. To give you an example, here's the Fed funds rate. You can see kind of like whenever we have really tough times, they have to cut the rate. So you can see they did it around 2008 and 9. They did it right around COVID, where it became literally zero. So when they do that, inflation goes up, and in order to cool it down, they raise it so that cost of borrowing becomes expensive. So at the top level, that happens to the banks because Fed funds rate is only applicable to banks. But when it costs them more money to borrow from each other, they're going to pass that cost down to us, which means auto loans, credit card, everything will just cost more. So that's how it trickles down to us. Also, they can use this to kind of like boost the economy or kind of like shrink the economy. They can also regulate money circulation. Like if you think about it, if they reduce the cost of borrowing, companies will essentially just hire more people. Why? Because there's a lot of demands. People will buy more things, goods and services, which means companies will have to hire more It's like a circle where you give more money in people's hands, they're gonna spend more in order to, provide the goods and services. You're gonna have more employment, and that gives them more money, and then they spend more. So, it's a vicious circle. So yeah, that's essentially that's why they use this as a primary tool to raise, essentially cool inflation, or tackle deflation. Side note: inflation is desirable. I always think of inflation in a funny way, like inflation is like milk. Skim milk, pass. I don't want that. I don't want whole milk or heavy cream, half and half, all that. That's too much. But I like 2%. It's not too much fat. However, there's still some in it. So it's kind of like that, where most governments, they want at least 2% inflation. We were way above that around 2022 to now. So that's why they had to raise the interest rate so much, and now they're slowly cutting the rate. Okay, so next thing, you might be wondering, so they cut Fed funds rate 3 times consecutively, as they announced, but the mortgage rate has not dropped. In fact, it's going up, and right now it's somewhere around 6.9 to 7. So what is happening? It should have gone down, right? It's not happening because of the mortgage spread. So let's kind of talk about that. So what is mortgage spread? If this is the first time you heard about it, it's okay, because it's essentially the difference between the 30-year mortgage rate and minus the 10-year treasury yield. So let me kind of explain it this way. Lenders or banks, they're here to make money. They can either buy treasuries at, let's say, 10-year treasury like at 4.5 and get interest, or they can sell us mortgage at 7%, right? So 7% minus that 4.5, that's about 2.5. That's essentially the spread. Now that spread covers lender costs, risk that they believe they're taking, and profit. So even though the Fed rate has been going down, the spread that they want has been going up. So the Fed rate cut got overpowered by the spread. That is why we're not seeing a drop in mortgage rate. And I'll show you show you a chart to kind of show that. So here's a chart of the mortgage spread over time. As you can see that in the recent years, it has been going up, where you can see that in the recent days, it is almost all-time high. So that shows you visually what is happening. So now let's go back to that. Okay, so what increases the spread? I listed some of the things here, but essentially credit risk. At this point, because the economy, everything is so expensive, we don't have a lot of discretionary spending left. Housing costs a lot of our significant portion of our income. Lenders believe there's a chance of a significantly higher amount of defaults in the upcoming days. Liquidity and investor demand, if they're not, there isn't a lot of demand for mortgage-backed securities, they could turn to the spread to make up for that. Economic conditions, we don't know what's going to happen. It's a new government. A lot of people think we're in a bubble, so they have to account for that. And also the Fed policy in general, whenever there's a rate cut or any rate change, investors all through the whole market reacts, and based on that the spread fluctuates. So let me go over a few examples of rate change scenarios. So here's one example that we kind of saw around 2004 to 2006, where Fed raised the Fed rate and mortgage spread didn't really change as much. It was kind of steady. When that happens, the Fed rate's impact kind of just trickles down and mortgage rate goes up. Example 2, we saw that around 2022 because of COVID, as you know, people got used to COVID, and 2022 Fed had to do something as inflation was just going out of control, right? So they had to quickly raise the Fed rate. Mortgage spread was also up because the lenders started becoming risk averse as inflation was high. So what that meant was the mortgage rate started going up really fast. So we saw it go from somewhere like 3s to like 6. And then example 3 is what I believe we're seeing right now. So Fed is cutting the rate. However, we have a lot of uncertain times that are coming toward our way. We have a new government. Inflation is not really, completely under control. So they want more security via the spread. So they're increasing the spread more at a faster rate than the rate cut. So what is happening is mortgage rate is still kind of going up, but it's not really going down. It's mostly staying same or going up. And that's what we're seeing right now. So I hope these things kind of help you understand what's happening, especially from that December 18 last announcement where they announced a rate cut. However, they announced that they will be doing not 4, potentially 2 rate cuts, which there was a gross overreaction in the market that day where the whole stock market collapsed. I think there was an overreaction. But then again, there's also a bubble, so maybe it needed to happen. Anyway, back to the mortgage rate. So we have 2 rate cuts coming and we have a new government coming. So we definitely have a lot to talk about when it comes to deciding if you should buy a home in 2025. So please stay tuned for the next video. And if you feel like you learned something, give it a thumbs up. And as always, thank you for watching.